our asset purchases might be adjusted, including their pace and composition, once economic conditions warrant a change.
The further we go out, the less we seem to know about how the Fed is, what their consensus is. Their consensus seems to be breaking apart.
They gave us some clarity, which is we're not going to tell you how we're going to taper, at least until December.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. Credit Suisse claws back $70 million in pay, punishing 23 people after finding staff at fault for its $5.5 billion losses tied to Archegos. Our interview with CEO Thomas Gottstein shortly. Ground to cover, the Fed inches towards trimming emergency stimulus, but Jay Powell warns there's still a way to go. And Bloomberg learns that China has convened its major investment banks to restore market calm. The CSI and Hang Seng rally. So yes, market calm. We are seeing global equity markets, not just in Asia, but in Europe and the U.S. start to move higher. So if Jay Powell didn't rock the boat, we had China calming the waters. That's exactly what we're seeing. So attention can now turn to earnings, and what a busy earnings season it has been. And of course, that's dominating some of the market moves in Europe, with Credit Suisse really under focus. It is under pressure after missing profit estimates for the second quarter. The aftershocks of Archegos and Greensill scandals continue to reverberate across the investment bank and wealth management business. In today's internal report, it laid the blame at the feet of the employees, repeatedly ignoring red flags, which led to the $5.5 billion of losses on Archegos. Here's what the Credit Suisse CEO Thomas Gottstein had to say this morning.
We are taking this event very seriously. We lost with one client 5 billion Swiss francs. So this is why we decided to publish the full report. It's over 160 pages. It goes into a lot of details about some of the failures, but also recommendations. The failures are centering around a lack of effective risk management in prime services, both in the first and second line of defense, a lack of oversight in the investment bank and risk management, a lack of escalation, and a lack of prioritization of certain risk mitigating steps, which had been discussed by some of the teams, like, for example, moving clients like Archegos from static to dynamic margining. But because we're taking this very seriously, we have decided to publish the full report, and we are now very much focused to take the right lessons learned away from this, the right read across, and we are doing a global risk review across the bank, and we will make sure that anything like that will never happen again.
Let's dig into the details now with our Patrick Winters, finance and investing editor in Zurich. So, Patrick, what did we learn that was new from this report that we hadn't already known about the failures at Credit Suisse?
Well, this report has been a couple of months in the making, and I got to say it's huge. So we've only been digging into the very first details this morning. It's 165 pages long, and that's just excluding the glossary. But what we do know is that in the weeks leading up to the implosion of Archegos, Credit Suisse began making payments to the hedge fund. And when the thing actually finally collapsed, management was surprised. So I think those are some of the key points which we've seen coming out from the report, but we're going to have to spend a lot of time digging into it.
I was going to say, okay, you have 165 pages on this internal report, but Patrick, you also have the earnings to dig through. Don't envy you, a very busy morning. So what did we learn on the results side of things of how the bank performed?
Yeah, I mean, looking at Credit Suisse's earnings, they've been subdued, to be honest. It hasn't been an amazing quarter or an amazing first half. Obviously, with Archegos and with Greensill, trading income is down versus Wall Street peers. Even in wealth management, they've seen some outflows as they've been de-risking. So, it hasn't been great. It hasn't been great, and stocks shares are also down. We're down as much as 5%. So, we'll have to see how this improves over the next quarters.
Yeah, and as you say, shares moving lower today by more than 3.4%. Patrick, thank you so much for joining us and giving us your insight. That's Patrick Winters, our finance and investing editor in Zurich. Now, smart conversations continue on Bloomberg Surveillance Early Edition. Jet demand storms back and Airbus lifts its goal. Coming up on the program, we will speak to the CEO of the European planemaker. But first, up next, we discuss the Fed meeting with Societe Generale's global chief economist, Klaus Baader. If you have any questions for him or any of our guests this morning, IB Plus TV Go on your terminal is where you want to head. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now to the Fed, where Jerome Powell sees progress on taper conditions, but says there is still some ways to go. The Fed chair says officials have taken a first deep dive on how to go about scaling back bond buying, but no decision on timing has yet been made.
The committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. We also reviewed some considerations around how our asset purchases might be adjusted, including their pace and composition, once economic conditions warrant a change.
We're now joined by Societe Generale's chief economist, Klaus Baader, to talk all things Fed. So, Klaus, first off, thanks so much for joining us this morning. I do have to say, it seems like a lot of the reaction to what we heard from Jay Powell was one of confusion. I kind of look at what Mohamed El-Erian tweeted earlier, saying that he expects that many people agree that this was one of the most confusing Fed conferences that we've had. So what did you make of it? Perhaps a more dovish language coming out of Jay Powell following the FOMC?
Well, I think we've seen a pattern where some of the senior members of the FOMC, and I'm thinking Powell here, I'm thinking Clarida, I'm thinking Williams, are more dovish than in particularly some of the regional Fed presidents. And I think that's showing up in the slightly confusing communication. But you know what I think, what seemed to me that what Jay Powell really wanted to do yesterday in the press conference, or one of the things he really wanted to do, is get the narrative back to where the Fed wants it. Because remember, after the June meeting, the focus shifted quite suddenly very much towards rate hikes, because there was the dot plot, and there were a number, 7 members, in fact, who thought that interest rates should be hiked the next year. And whereas the Fed, I think, and in particular the leadership of the Fed, very much wants to focus on the tapering first. And so I think this was a reassertion of that narrative, and Powell made it very clear that they're nowhere near, I think that's the exact quote, nowhere near the point where they would want to raise interest rates.
Okay, so that's definitely interesting. The focus here then being on the taper, don't concentrate on the interest rates. I do have to say, I did love the way that Robert Armstrong, opinion writer over the FT, described what Powell was trying to do. He likened him to a character on the horror movie A Quiet Place, just trying to tiptoe around, not wake up any of the monsters. And for now, he's been successful. If I can take his analogy further, is there a risk that Powell does wake up the monsters once he needs to start tapering and perhaps needs to start talking about raising interest rates?
Well, I think that raising interest rates is, as I said, a long ways away. I think you've got a year probably at the least until that issue comes up. It's a very good question. Are markets going to go have another taper tantrum? You know, there are some who argue, and I think with some justification, that really the taper tantrum already happened at the beginning of this year when bond yields rose quite a bit. So, you know, I don't think that this is going to go completely smoothly when the Fed announces that tapering is going to begin. I think that there will be some upward movement in bond yields. But until now, he's been successful. You know, markets are pretty calm and quiet. Afterwards, there was very little movement in the dollar and little movement in the bond market. So I think, you know, it was in that sense, it was mission accomplished, because I think that's one of the key things that the Fed wanted to do. You know, at the same time, Powell made very clear that they had, as what he called, a deep dive, and that the tapering isn't that far away. You know, our longstanding expectation has been that tapering starts at the beginning of next year in January, but chances are it could happen a bit earlier.
So while he was talking, we did see real yields continue to dip lower, I think beyond negative 117 basis points at one point. I think that's around where we're trading at the moment for the U.S. 10-year real yield. What does that tell you? There have been some rumblings that perhaps this signals a policy mistake. Perhaps it's stagflation. Are you getting any clear signals for where we see the bond market at the moment?
No, I think, bond market movements have been very odd. We've seen a moderation in inflation expectations when inflation readings continue to massively surprise on the upside. I think it has a whole lot to do with positioning. There was a lot of steepness in the market. When that suddenly didn't work, everybody headed for the exit. I don't think that the bond market at the moment is tracking particularly closely developments in the economy. That said, there are, of course, jitters about is the pandemic going to return? Is the Delta virus going to derail the reopening of the global economy? And is it perhaps going to reverse the pretty much total normalization in the U.S. economy? I think those are the background, the uncertainties. But I don't really think that people are that a lot of people out there are thinking about that kind of scenario. About stagflation, right. I know that's been a hot topic. I think growthflation is a hell of a lot more likely than stagflation. And the main reason why I say that is the following. As we well know, not just U.S., but households in all industrialized economies are tanked up with excess savings. In the U.S., that's about $2.5 trillion. That's more than 11% of GDP. Now, not all of that is going to be spent, and not very quickly, but it's fuel for growth.
Right. Klaus, I'm so sorry. We are out of time. It's so great to have you this morning to dig through all the latest with the Fed. We're going to have you back for longer. Klaus Baader, Chief Economist at Societe Generale, thanks again for joining us. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Jet demand storms back and Airbus lifts its profit goal. Up next, we will speak with the CEO of the European plane maker. If you have any questions for him, as always, IB plus TV Go on your terminal. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. We are seeing markets heading higher today, not just in Europe, not just in the American pre-session, but certainly in Asia as well. Here's where things stack up. Your Hang Seng Index up more than 3.25%. China coming in and calming the banks, talking with the banks, saying that this sell-off is not supposed to be widespread, that what they're doing in the ed tech sector is really contained to there. So that helps soothe some of the markets. Also helping soothe the market was Jay Powell yesterday as well, not rocking the boat. Now, earnings is where our focus turns to next, and Airbus has raised its guidance for profit and aircraft deliveries. The plane maker says it will build a new freighter in a sign of rising optimism that demand is rebounding from the pandemic. China and the U.S., with their huge domestic aviation markets, have led the comeback. My colleague Matt Miller joins me now with the CEO of Airbus. Matt?
Danny, thanks very much. Yeah, Guillaume Faury joins us now to talk about the Airbus business after a banner quarter. Guillaume, thanks so much for your time. Let me first ask you, before we get to the freighter that we want to talk about input costs and about the possibility of you passing costs on to customers. How have you seen inflation and how are you dealing with it?
Well, first of all, happy to be with you today. We have posted good results today, and I'd like to thank the teams for all what they have done. Now, when it comes to the customers and to your question, well, we are delivering from the backlog. So we are in a situation where what we have negotiated with the customers was mainly about deferring the deliveries of the planes and not too much about the price. The work on the cost has been really on our side with our teams, with the suppliers, and with adapting to the new situation. And we see with the numbers we have released for the second quarter of the year that we have actually well adapted to the new environment we are operating in. But now there's a new phase in front of us as we start to ramp up again.
So what is that phase? I mean, do you see continued inflation in terms of costs, and do you see sales continuing at the same pace? I noticed that you're looking at 600 for the full year. It seems like you could actually do a lot better than that. Are you being a little bit conservative there?
With 600, we have actually already upgraded our guidance for the full year. The previous guidance that we had released in February earlier this year was for at least the same number as last year, which means at least 566. Now we're saying around 600 planes. It's a lot in this environment, but we think it's manageable, it's feasible, because we have already delivered 297 planes, which is actually a very strong first half of the year. Now, you're right to point to the cost situation. We see inflation in many areas with raw material, very strong inflation on raw material. There is scarcity for a large number of them. We see also a lot of inflation on logistic costs, sometimes skyrocketing costs. And we saw also scarcity on some skills. After the period where we had to adapt the workforce to the pandemic situation, we are now starting to hire again, and it's not always easy for us and for the supply chain. So it's a new period ahead of us. We start to ramp up again on the 320. That's good. There is demand. Airlines are willing to take delivery of the planes again. But it's a very different environment. What we call the new normal, the post-COVID-19 situation is going to be different from the pre-crisis situation.
You know, I was talking to Herbert Diess a little bit earlier today, the CEO of Volkswagen, and he was saying that the supply chain issues, especially the chip shortage issues, may sort themselves out by Q4. Do you see a similar timeline?
Actually, we've not been impacted too much by this shortage in chips that has actually been quite tough to manage for the automotive industry. So we've not been exactly in the same situation. We fear the situation for the aerospace industry, where the two big players are starting to ramp up again their production rates on the single aisle. That's why we have communicated very proactively with the supply chain to give transparency, to give them the opportunity to anticipate the situation of ramp-up that we see on the A320 family, and probably similarly for our main competitor on its product in the single aisle. So we need to be prepared, and we're working very actively with the supply chain to help them being prepared, to have the level of transparency, of information they need to do the investment and the recruitment that they need to make to enable that ramp-up.
You know, in terms of labor, a lot of people think of Airbus as a very French company. I've been to some of your plants here in the U.S., so I realize it's very global. How difficult is it for you to get staffing back in to help with your ramp up?
Indeed, we're a European player and not a French one. We're really a European company. We are incorporated in the Netherlands with main activities in Germany, France, UK, Spain. But we are not, I call it, we are not a European Boeing, as we have activities, plants, operations across the globe, and a lot of operations in the US. It comes with complexities, in particular in times of COVID-19 and with all the travel restrictions. So it's not an easy setup. But it also drives performance, as we have strong presence in the countries where we are operating, where we are selling. It creates proximity to the customers. So we have some pros and cons, and we are managing that complexity as good as we can. And we welcome the recovery of air travel and the reopening of the borders, because for a company like Airbus that is really operating on a global scale, that's very important for us and for the customers we serve.
But are you finding it difficult to add enough workers?
It's a concern. There are a lot of places and particular skills where we find it difficult to recruit. Again, in particular in digital for data scientists, data analysts, or also in the field of artificial intelligence, cyber. But that's not specific to Airbus. That's a bit around the globe. And also when it comes to very specialized, what we call blue workers, people working on the shop floor, that in aerospace need to be very skilled with their hands, but also very educated, as we are working in a high-end product, complex environment, and we need people really skilled people. And that's what we like to to recruit at Airbus and to develop. We develop those people as much as we can, but the pandemic has been a bit of a shockwave, and now we are recruiting again. That's good, but with more difficulties than we had in the past.
And you've got new projects. You announced today you're going to pull the trigger on the A350 freighter. Everyone's been really excited about this story. What kind of launch customers are you going to aim for here? Who is this product for at the start?
Well, this product benefits from the strengths of the A350 family. That is today the most modern airplane in the wide-body segment, with very strong performance, low operating cost, very high operational reliability, and also a very low fuel burn, which comes with very low carbon emissions. And we have seen new regulations kicking in that will make the existing products obsolete by the end of the decade. So the product really comes at the right moment in terms of regulation, but also in terms of market needs, as we've seen an increase in the demand for transport by air, for the freight, and at the moment where we will see a wave of replacement of the existing planes. So we have around 2,000 freighters flying around the world, and we are tapping into that market segment.
Could Qatar be a launch customer for you? I know you've got a dispute there over paint issues. Is it still possible you could get them on the launch?
I will not comment on the specific customers. We have a negotiation ongoing for the product, and we will be more specific when we will have concluded the negotiations. But obviously, most, if not all, of the large operators of wide-body freighters are interested by the A350 freighter.
All right, let's talk about the Air France KLM order, their negotiations with you and with Boeing for 160 jets. It's a big order. Can Airbus be competitive here? Do you think you have a chance?
Of course we do. Of course we do. And Air France KLM is a very important customer of Airbus historically. We want to be competitive. There are a lot of ongoing campaigns and negotiations. We won't be able to respond to everyone. But obviously for Air France KLM, we'll be competing as strongly as we can, and we will make sure we can offer the best solution Airbus can propose to Air France KLM.
And you have been competing very strongly with Boeing. They haven't really been a very strong competitor of late, but it looks like they're making a comeback. Can you see a strengthening of that competition after they posted a profit and look to be stronger in terms of their finances?
The competition between Airbus and Boeing has always been very fierce, very strong, to the benefit of the market. The airlines and the lessors have always been very creative to make sure that this competition would stay active, and it's on. The competition is on. We see indeed our competitor very much willing to win campaigns, to ramp up again their productions, and that's the world we're living in. It's a world of competition. At Airbus, we enjoy that competition, and we always try to bring the right products, the right services to our customers so we can be competitive. But we know the other ones try to do the same. So that's the nature of competition.
Guillaume, thanks so much for your time. Really appreciate your views, your insight there. Airbus CEO Guillaume Faury talking to us after earnings and a new product launch this morning. Danny Berger, with that, I'll toss it back to you.
Yeah, Matt, fascinating conversation talking about what he called skyrocketing costs and costs related to skills, something we're hearing from so many companies. Fascinating to get the view from Airbus. Matt, thank you so much. Now let's stick with the earnings conversation. And Credit Suisse is under pressure this morning. The Swiss lender's profit missed estimates as it works to recover from one of the most turbulent periods since the financial crisis. Our Anna Edwards spoke to Credit Suisse CEO Thomas Gottstein earlier, and he promised no more Archegos-type errors.
Yes, we are absolutely doing this strategic review together with the board of directors and the executive board. We are having very constructive discussions. We want to take our time to do that because this is not something we want to do in a rush. We have a clear intention to formalize a long-term vision for the bank and a concrete midterm plan. And this is what we're doing now together with the board of directors. And we are looking obviously at all the options, but we have some very clear views in which direction we are going, but we will not now, as you can imagine, start to disclose part of that strategy. We will communicate it when we are ready to do so.
But we should still consider investment banking as core to Credit Suisse, should we?
Look, we have been investing, as you can see in the numbers, both in terms of technology, in terms of in people. I'm going to pitches myself, so investment banking has been and is absolutely core to our business, and we are investing in it. We are spending a lot of time with clients, and as you know, we have a strategy where we bring our wealth management capabilities together with our investment banking capabilities available to clients, be it private clients, corporate clients, or institutional clients.
And what can you tell us about the response at Credit Suisse to the risk review that you've also published this morning, Thomas? It says that the risk control architecture was not lacking, but there was a failure to discharge supervisory duties and prioritise risk mitigation. So what is left to do then in shoring up Credit Suisse to make sure that risk management is robust?
Well, as I said, we are taking this event very seriously. We lost with one client 5 billion Swiss francs. So this is why we decided to publish the full report. It's over 160 pages. It goes into a lot of details about some of the failures, but also recommendations. The failures are centering around a lack of effective risk management in prime services, both in the first and second line of defense, a lack of oversight in the investment bank and risk management, a lack of escalation and a lack of prioritization of certain risk mitigating steps, which had been discussed by some of the teams, like, for example, moving clients like Archegos from static to dynamic margining. But because we're taking this very seriously, we have decided to publish the full report. And we are now very much focused to take the right lessons learned away from this, the right read across. And we are doing a global risk review across the bank, and we will make sure that anything like that will never happen again.
Credit Suisse CEO Thomas Gottstein speaking to Anna Edwards just a little bit earlier today on all things Archegos and earnings. Now, moving to China, where Beijing's moves to calm the market do appear to be working. Stocks in China and Hong Kong rebounded in today's session. In a Bloomberg scoop, we found that the Chinese securities regulator told major bank executives that the education crackdown was targeted and not intended to hurt other sectors. It's the latest sign that authorities have become uncomfortable with the sell-off that set the nation's key stock indexes to the brink of a bear market. For more on the China market action, let's bring in our Juliet Sally in Singapore. So, Juliet, is it all clear now?
Well, that's a big question, isn't it, Danny? Certainly a lot of analysts out there with differing opinions on this, but certainly we had a lot of factors today contributing to this very solid session that you saw in Asian markets. And also important to point out that some of these Chinese stocks listed in the US, the large cap stocks, look like they are going to open higher too. We're seeing the likes of Alibaba jumping by 2.8% in New York trade and Didi Global up by 4.4%. Here in Asia, though, the CSI 300, which earlier in the week had been teetering on that bear market, which didn't even happen during the pandemic, rose by 1.9%. We also saw big buying coming back through into the Hang Seng and Hang Seng Tech Index, which actually had its biggest jump on record, up by 8%. A lot of that helped out by a big rally coming through in Tencent, which had been a very bad performer over the course of this month, up until yesterday, losing something like 23%, $170 billion of its market value. There were a number of factors. We had been talking earlier this week about state media stepping in. Then you also had had regulators speaking to the big banks saying, look, these changes in terms of the education policies are not intended to hurt other sectors. All of this flowing through into the bond and currency markets too. The offshore yuan having its biggest jump in a week, up 0.4% after it had hit April lows earlier in the week. But to your point, does this mean the end? Well, of course, everybody is still trying to scramble this out. JP Morgan, though, if we look at our morning call, certainly doesn't think that we are out of the woods yet. They're saying that, look, retail and momentum trade is one thing, but you've also got to look at these foreign outflows, which we had been seeing coming through the Stock Connect. So they're saying there's still some risks ahead and that the sell-off that you saw this week could, in fact, just be the beginning rather than the end of a new outflow phase. Danny.
Okay, so more of a dead cat bounce. Juliet, thank you so much. That's our Juliet Sally in Singapore. Now, back to the earnings picture where the AstraZeneca CEO says the company is not there yet on switching its COVID vaccine to profit. Up next, we hear from our Pascal Soriot on our interview, with Pascal Soriot. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, AstraZeneca raises its earnings and sales forecast for the year. That's after the British pharmaceutical giant closed its biggest deal in 2 decades, the acquisition of Alexion. In terms of its COVID vaccine, the sales totaled almost $1.2 billion for the first half of the year. Astra also made commitment to providing the treatment at cost throughout the pandemic. CEO Pascal Soriot told Bloomberg that the company is not there yet on turning a profit on the vaccine.
We went through a transition period and planning the transition before we closed the deal. And when we closed the deal, we were ready to go. So we are actually already in full operating mode. The two companies have very, very similar cultures. People are really collaborating very, very well. And we've been able to, from day one, get going. We had, welcoming meetings yesterday to the new staff, and I think we're going to do very, very well together. And two great companies coming together.
You mentioned also the success you've had in the number of vaccines that have been rolled out, Pascal. What should our expectation be for the number of vaccines that we can get to emerging markets and how we increase production for maybe in emerging markets? There's been a lot of heated debate within the sector, I know, and some governments weighing in on intellectual property, whether that needed to be relaxed. I know the sector has fought back against those proposed changes. What is the secret, do you think, for increasing levels of production to poorer countries?
Well, actually, we have just delivered 1 billion doses, and 60% of those doses are going to the low middle income countries in our case. So we've really tried to live up to our commitment to broad and equitable access. The problem is there's not enough vaccine, of course. I mean, every company is working as hard as possible. Pfizer, Moderna, J&J, ourselves, everybody's working, 24/7 to produce more. But at the end of the day, there are, billions of people in the world that are waiting to be vaccinated. What we've done is we've set up a network of partners around the world. We have 20 sites making vaccines. People say you should open new sites. We can't. We are at the very maximum of what we could do if we want to make sure we produce a vaccine that is a good quality vaccine in line with the quality we should expect to receive from AstraZeneca. So it's a question of patience now. The little issue we've had in our case is our partner Serum Institute, which is the largest manufacturer of vaccine in the world, has basically been unable to export. And our plan was that half of their production would go to low middle income countries around the world. Everything stayed in India, as you know, because of the explosion of this pandemic in India. But soon enough, they will be able to restart exporting.
You have said in the past, of course, that you'll provide the vaccine at cost, Pascal, and that was part of the reason you managed to do the deal with Oxford in the first place. So provided at cost. With the UK and other nations, though, now starting to reopen, do you have a sense of when you will no longer provide it at cost?
Yeah, we've been doing this vaccine production at no profit, and in fact, in Q2 we had a small loss. From quarter to quarter, we can have a small loss or a small profit. More or less, we are around zero profit. We said we would actually provide the vaccine at no profit during the pandemic. And we still have large quantities of vaccines to deliver between now and the end of the year, and this will be at the same price, at the same conditions as were taken at the beginning of the pandemic. So at some point in time, new orders will become orders will supply at affordable price, but some profit, but affordable prices. But it is not, we're not there yet. Soon enough, we will do that for new orders, but we're still very busy supplying the orders we have at no profit.
And so those affordable prices, any sense of how that will be measured? What will your guardrails be? How will you define that?
Yeah, affordable price means we will have tiered pricing. So for the low middle income countries, we will be at very low prices, quite frankly, very minimal profit. And of course, more expensive, a little bit more expensive for the richer countries. But even in the richer countries, our price will always be moderate. We don't intend to make large amounts of profits out of this vaccine. We can't do it at no profit forever, but certainly we will never make large amounts of profits out of this vaccine.
That was AstraZeneca CEO Pascal Soriot speaking to Bloomberg just this morning. Now, joining us to discuss the AstraZeneca results is Sam Fazeli, Bloomberg Intelligence Director of Research. Sam, what are shareholders worried about AstraZeneca not being able to turn a profit on its vaccine? Why is that such a concern there?
Actually, I don't think that's necessarily a big worry for people because the company had always been quite clear that the vaccine will be, at least for the pandemic part of the of what we're going through, at no cost, which is what they're living up to. I'll just tell you that Johnson & Johnson, who are doing the same thing, have suggested that after the end of this year, they will be looking to make a profit from their vaccine. Again, with the same background, i.e. higher income countries paying more, low income countries basically paying costs. So I think Astra will probably follow the same path.
Okay, what about in terms of general results that we've seen across the pharmaceutical industry? How does AstraZeneca compare to some of its peers like Pfizer that we've already heard from?
Yeah, so Pfizer obviously is in a very different situation in that from day one, they said they're going to invest all the money themselves. And then if the vaccine works, they will sell it at profit, which is exactly what they're doing. And yesterday, they upped their expectation for the vaccine sales to $33.5 billion for the year. I mean, the mRNA vaccines, which, of course, Pfizer's one, which they developed with BioNTech, is one, are proving to be the better vaccines compared to the other technologies that are currently available. So I think it turned out that it was the right thing to do for them. Astra's obviously losing a little bit of money this quarter and last quarter on their vaccine. So I think people should remember that when they criticize the company.
All right, Sam, if I can zoom out to kind of more of the general virus pictures, we've had a lot of different corporations, be it Twitter, Google, Lyft, talking about either extending the time that people are working from home or saying if you come in, you need to wear a mask. It kind of feels like we're moving backwards. Is that a fair way to look at it? Or is it just that perhaps some of these corporations were too premature in general to loosen some of their restrictions?
Yeah, you know what? I don't think this is the first time we've done this. I mean, last summer, most people thought that this was finished, if you recall. And the world just opened up and did what it wanted. And then, of course, it was hit heavily with a wave of infections starting in September, October timeframe. So, and now on top of that, we have to layer the variants. At the moment, it's the Delta variant we're dealing with. So I think we do have a risk of putting the rose-tinted glasses on a bit too soon. And now we've proven that 2 or 3 times with this virus.
So at the same time, you also have Sydney tightening the rules on travel. How much of what's happening in the southern hemisphere winter is indicative of what's going to happen in the rest of the world once we head into the winter time?
Yeah, I mean, it gives us some indication, but let's not forget that those countries have had much lower tolerance for infection rates than we have, for example. I mean, in the UK, we've opened up knowing that we have a high rate of infections, way, way higher than they're seeing, at least in Australia, for example. So I don't know if we can use them as a playbook for what's going to happen in the winter here, but it's not going to be easier because we certainly are starting with a higher case count.
Right. That certainly makes sense. Well, Sam, thank you so much. Always great to get your insight. That's Sam Fazeli, Bloomberg Intelligence Director of Research. Now let's get to your Bloomberg First Word Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Nestle has reported stronger than expected first half organic revenue growth of 8.1%. The world's largest food company is also raising its full year outlook for organic growth to a range of 5 to 6%. But the company joined peers in warning of pressure from rising raw materials and transport costs. Now, Anglo American has reported its highest ever interim profit and will return more than $4 billion in dividends and buybacks as it cashes in on surging commodity prices. Anglo reported underlying earnings of $12.1 billion, up from $3.4 billion a year earlier. The trillions of dollars poured into economic recovery packages have ignited demand for commodities like iron ore and copper, driving prices sharply higher. AB InBev's profit has risen less than estimates as a result of higher commodity and marketing costs, as well as currency-related effects. The world's biggest brewer saw adjusted EBITDA gain 31% in the second quarter, lower than the 41.6% expected by analysts. The Budweiser maker flagged higher raw material costs in key markets such as Mexico, Brazil, and Colombia. And Robinhood Markets has priced its IPO at the low end of the marketed range in a muted showing for one of the year's most highly anticipated listings. The price indicates investors weren't clamoring to buy the trading app company stock in the way they had been with some of the year's hottest offerings. It puts Robinhood's fully diluted market value at about $33 billion. And that's your Bloomberg Business Flash. Danny.
So much. Yeah, hotly anticipated IPO getting a pretty muted response so far. Well, coming up as investors grapple with the Fed, Beijing's intervention in China's markets, and a busy day of earnings here in Europe, we'll jump back into the markets with MLive's Laura Cooper next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. It's certainly a more calm day in markets. Two major risks out of the way, at least for now. We had the Fed not upsetting the apple cart, not overturning the apple cart. We also have China stepping in, at least reportedly meeting with banks to kind of soothe the market. So you're seeing a Hang Seng ending the day higher, up more than 3.25%. And both in Europe and U.S. American futures moving higher this morning. Europe definitely outperforming. The laggard, of course, is big tech. You had some more disappointment from Facebook that seems to be dragging the market lower. But let's dig into some of this market action with Laura Cooper, Bloomberg's MLive macro strategist. Laura, an extremely busy day, both macro and micro forces here at work. I look at the tech earnings, for example. Okay, Facebook disappoints. It's down about 3.5% pre-market so far this morning. That means NASDAQ futures are off. But how important is this earnings season to either cement or deny tech its leadership role in the market? Can earnings have that impact, or are we just, going to buy growth regardless?
Well, I think earnings aren't actually having that impact. And that's because largely when we see it, the price action shows us that the bar is so high for those earnings estimates. So the fact that, more broadly, tech is beating those expectations, we are seeing price action fall the following day. Its relative performance of the average stock is actually down the following day as well. And I think this more broadly captures this still lingering trend of the fact that we are going to see this rotation in leadership in the U.S. away from those big tech, because the cost of playing defense in that sector is becoming exceptionally prohibitive.
Yeah, that's fair. I mean, certainly some frothy valuations. I mean, on that note, do we kind of have any idea of how hated this bull market is? I mean, is it one of those things that we continue to have to hold our nose and just buy into, especially given where bonds are?
Well, I think certainly, bonds are telling us a completely different story still than equities. And I think, yes, we have these peak U.S. growth fears that are kind of percolating within that bond market. But ultimately, this still is a U.S. recovery that still has momentum. We do have Q2 GDP out later today. It's expected to show quite a strong advance at 8.5%. And we are still having those kind of more timely indicators suggest that growth does remain robust. And this is a recovery that is making progress. Fed Chair Powell alluded to as much yesterday. So I do think there is still a case to have kind of continue to buy any dips in these equity markets.
What about the buy the dip case for China? How is that playing out right now?
Well, certainly we had overnight China inject that short-term liquidity into the system. We also had China kind of assuaging these fears about the regulatory crackdown. So companies are able to list IPOs in the U.S. And that did spark just this strong rebound that we are seeing across Chinese assets. Now, this is still a story about deleveraging. We do still have quite a hot housing market there. There does still remain this ongoing uncertainty related to the policy measures going forward. So I do think, there is still a case for, U.S. and European equities over China. I think that's a story that's largely played out so far, but certainly risks ahead.
Laura, thank you so much for joining us this morning. That's Laura Cooper, Bloomberg's MLive macro strategist. And remember, today we're asking the question on MLive, how will China's slowdown affect risk assets? You can join the debate, reach out to us and the MLive team. IB plus TV Go on your Bloomberg is where you always want to go. And as Laura pointed out, we did see Asian equities end the session higher. That optimism does seem to be extending to the rest of the market. And we'll continue to discuss that on Bloomberg Surveillance Early Edition. We continue in the next hour. Matt Miller and Kailey Leinz both join me out of New York. Not only do we have China, we of course also have the Fed and this raft of earnings that the market is trying to wrap their head around as corporations warn of inflation. We discuss that next. This is Bloomberg.
Our asset purchases might be adjusted, including their pace and composition, once economic conditions warrant a change.
The further we go out, the less we seem to know about how the Fed is, what their consensus is. Their consensus seems to be breaking apart.
They gave us some clarity, which is we're not going to tell you how we're going to taper, at least until December.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, July 29th. Our top stories today. The Fed stays calm while China tries to reassure investors weigh moves from the world's two largest economies. President Biden's big boost, the Senate votes to start on his infrastructure plan, and Democrats get behind his budget resolution. And Credit Suisse feels the pain. Those twin scandals helped drive down net income by 78%. We wrap up a big day for earnings in Europe. I'm Danny Berger in London alongside Matt Miller and Kailey Leinz in New York. Francine Lacqua is off this week. And Kailey, calm restored to the markets. I think the best metaphor I've seen is Powell did not rock the boat and Beijing calmed the waters. Just how calm are the waters out there right now, though, Kailey?
Well, in Asia, I wouldn't even say they're calm. I would say they were kind of frenzied to the upside, in that we saw a huge recovery in both China and Hong Kong. In China, the CSI 300 was up more than 1%, and in Hong Kong, the Hang Seng up by about 3.3%. And of course, it really was the tech stocks that outperformed in a big way. The Hang Seng Tech Index up a whopping 8% on the day. It has recovered a large chunk of the losses of earlier this week. That is as China takes steps to calm the market, the PBOC injecting liquidity, state media talking up stocks, and then reports overnight that China is actually going to allow local companies to go public in the U.S. And that gave a big lift to Chinese companies that are listed here stateside, including JD.com, which is up 18% in the Asian session. You're also seeing a nice lift to the Chinese yuan. It is stronger against the dollar, sitting at 645, just shy of 646, while your big outperformer in Asia is actually the South Korean won, up about 0.7% against the dollar, coming off of its weakest level in 10 months. As for the picture here in the U.S., of course, you had the Fed pretty much singing the same tune. Yes, they are talking about tapering, but no, they aren't acting anytime soon. That coupled with an infrastructure deal finally happening on Capitol Hill. We're just waiting for the debate and vote on it. All that said, though, futures aren't getting that much of a lift this morning. We're up just about 5 points on S&P 500 futures. In the bond market, we're ticking 2 basis points higher on the 10-year yield. We're sitting right around that 1.25% level. And real yields, of course, dropped to a fresh record low off the back of the Fed yesterday, negative 117 basis points, even if we are lifting off those levels this morning. And of course, those lower real yields plus a weaker dollar giving a nice lift to gold this morning, Matt. Futures for gold up about 1% at this point.
Yeah, the weaker dollar really evident when you look at what's going on in Europe right now. By the way, I just see a headline crossing the Bloomberg. Euro area July economic confidence up to 119. The estimate was for 118.2. So beating the street just a little bit, beating our survey of economists just a little bit. It looks like there is a lot of economic optimism there. You can see it playing through in the markets here. We have green pretty much across the board. Belgium is down and Portugal's not doing much. But I guess the DAX is only up 0.2%. Airbus is really shining bright today. Take a look at some of the movers that we see. We had some positive earnings out from Volkswagen. It's kind of a special day for me because I got to get up early and talk to the CEO of Volkswagen. I also got to talk to the CEO of Airbus. And these companies are really firing on all cylinders. I guess that pun was intended. You can see Airbus stock up 4% right now after they announced a new freighter. They're going to build out the A350, their wide-body plane, into a freighter, which is really cool. Volkswagen finished its or agreed to purchase of Europcar, the rental company, yesterday, and came out with earnings that beat estimates, an outlook that was raised, and they say they're still going to boost production 10% this year. So things are looking good. Not so much for AB InBev, Anheuser-Busch InBev, of course, the maker of Budweiser, the beer water that people drink here in America, down more than 5% right now because increased costs are hurting them and shipping costs are hurting them, and they're having trouble passing those costs along to consumers. So this inflation talk is really something that we've heard from all of the companies bringing out earnings today. And for most of them, inflation is real, and it doesn't really seem very transitory, Danny.
Matt, you're giving us wake-up time inflation. You didn't wake up in the morning. You woke up in the dead of the night, getting up at 1 a.m. I'm sorry, that's not early morning.
Well, yeah, I don't really have my schedule set in stone. And anytime I get to speak to a car maker CEO, I'll get up in the middle of the night, no problem.
I know you will, Matt, giving us those excellent interviews. And yes, your Airbus interview, fantastic. They have that ability to pass on those costs, not worried necessarily about those higher prices that they're seeing, are they, Matt? Now, let's take a look at what's ahead today, because we have a lot on top of all of the earnings. Robinhood begins trading on the NASDAQ today. The trading app company priced its IPO at the low end of a market range. So a very hyped IPO with so far a muted response. We'll also get the latest CPI from Germany. That's 8 a.m. New York time. And then half an hour later, investors get their first look at U.S. second quarter GDP. We also have initial jobless claims to be released as well. And finally, one of the last big dogs in tech reports, that's Amazon, their second quarter earnings, which we will get after the market close. Now let's head to D.C., where President Joe Biden's ambitious economic plan got a major push forward. The U.S. Senate has voted to move ahead with a broad infrastructure package just hours after a bipartisan group of senators and President Biden reached an accord on a $550 billion plan.
And I'm working with Democrats and Republicans to get this done because while there's a lot we don't agree on, I believe that we should be able to work together on the few things we do agree on. I think it's important.
Jack Fitzpatrick, Bloomberg government reporter, joins us now. So, Jack, we have this coming up for a vote. What's the timeline look like now? What can we expect next?
Well, they took the first procedural vote on this infrastructure bill last night, got 67 votes in favor, which is enough to move forward. What's next is they say they've nailed down all the details, but we still haven't seen the actual legislative text of the bill. Not all the senators have seen the bill itself, so they need to turn it into legislative text in a bill. 30 hours goes by, according to Senate rules. They have another procedural vote. They'll try to wrap this up before leaving for recess at the end of next week. When it comes to making this law, Keep in mind, Speaker Pelosi in the House has said that she isn't going to allow the infrastructure bill to go forward until they also get that next reconciliation bill. They're talking about $3.5 trillion. So there's a way to go before it becomes law, but the Senate can move ahead on its votes, at least to get things started on infrastructure.
So, Jack, when it comes to that $3.5 trillion of more socially oriented spending, what's the timeline for that? When could we see that reconciliation process taking shape?
They could start votes and plan to start, again, the early procedural votes soon to make sure they have the votes. That is a longer process. Essentially, to pass things in the Senate in a partisan way without Republican votes, you kind of have to vote twice and allow a bunch of amendment votes. So what they'll do is put out a framework that does the basic numbers, vote on that. There's then an unlimited number of amendments to that framework that anybody can offer. It takes a while. Then they do the bill and they have to vote again and at least get 50 votes plus the tiebreaker being the vice president on that. That could be later in the year. That's not the kind of thing they're going to be able to wrap up before their August recess. So when it comes to both the infrastructure measure having a chance in the House, because these are linked there, and seeing that $3.5 trillion measure, that's going to be later on. It's hard to say exactly when they'd wrap that up, but later in the year. But they can at least start the procedural votes and test this out and see if they can keep all the Democrats
It'll be interesting
together
to see if they can get the bipartisan bill through without that reconciliation, because, of course, that's been the Pelosi threat, that she won't do one without the other. Jack, thanks very much. Bloomberg Government's Jack Fitzpatrick reporting on a story that we're going to continue to cover, obviously. Now, the Fed is moving closer to reducing its massive support for the U.S. economy, but Chair Powell says there still is a ways to go.
The committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. We also reviewed some considerations around how our asset purchases might be adjusted, including their pace and composition, once economic conditions warrant a change. The labor market has a ways to go. We've got, 7 or 8 million people, fewer people at work than were at work before the pandemic. With successive waves of COVID over the past year and some months now, there has tended to be less in the way of economic implications from each wave. We're looking at tapering asset purchases. We're clearly a ways away from considering raising interest rates. There really is little support for the idea of tapering MBS earlier than Treasuries.
Bloomberg Juliet Sally joins us now to talk about really how the market has reacted to this. And as Kailey was saying earlier, it's kind of frenzied to the upside in Asia.
It was frenzied to the upside in Asia, Matt. Certainly this reassurance coming through from Jay Powell. I was also just reading something that Simon Flint has found on the MLive blog from Goldman Sachs report into what the Fed said, saying that it's interesting they took out the word significantly in terms of how the economic path really depends on the virus, saying that is what they're looking at, but they did remove that word significantly. So Goldman Sachs saying perhaps this is a little bit to mollify the hawks. But in terms of what we saw from the Fed, of course, we know the risks to the economic outlook remain uncertain, and we're going to get to, I guess, a broader picture of how this is all going to play out with the second quarter GDP numbers coming through in the US, Danny. And another interesting point is you're going to have two Fed speakers this week. You've got James Bullard, who's a hawk, and also Lael Brainard, who's a dove.
And of course, the other thing pushing equities to the upside is the action out of China and regulators and authorities there. Clearly, they don't want as much of a market reaction. What sort of levers have they been able to pull in order to, as Kailey said, put this frenzy into Asian equities?
Yeah, it was an absolute turnaround today, and you've actually got the regional benchmark index in Asia back to where it was on Friday, so it's almost as if this volatile week hasn't happened. But you had liquidity coming through, $4.6 billion coming through from the PBOC. You had those soothing words coming through from state media, and then you also had regulators speaking to major investment banks saying, look, these changes to education policies are not something that they want to filter through into other industries. That certainly saw a lot of buying coming through in these equity markets. Kailey was pointing out the Hang Seng Tech Index index in particular, having its biggest jump on record. And we saw the CSI 300, which was teetering on a bear market. That didn't even happen during the pandemic, rise by 1.9%. I also want to point to what's going to happen most likely in your session, because we did see these big jumps coming through in the likes of Tencent, Meituan, and that's flowing through into some positivity in these Chinese stocks listed in the US in pre-market as well. So you've got Alibaba up by 2.7%. So a little bit of calm coming through, Kailey. Does it last? We don't know. JP Morgan saying you should also be watching these outflows because that could be problematic more long term for the Chinese equity picture. Kailey.
All right, great roundup. Thank you so much to Bloomberg's Juliet Sally. And now on to Credit Suisse. It is under pressure after reporting a bigger than expected drop in second quarter profit. The aftershocks of the Archegos and Greensill scandals are still being felt in the investment bank and wealth management businesses.
We had another $600 million roughly of Archegos charges in the second quarter, which took the overall charges to about $5.5 billion for the first half. But on an adjusted basis, our pre-tax income in the investment bank was over $600 million. And if you take the full first half, it's $2.8 billion, which is a record. So the underlying business in investment banking has been very strong.
Let's get more now on this with Sonali Basak, Bloomberg Wall Street reporter. So Sonali, clearly a lot to unpack here with Credit Suisse. What are your big takeaways?
So in addition to that revenue not really meeting analyst expectations, you had 165-page report on Archegos. That is a whopping report that you saw from Paul Weiss that detailed how much they brought in from Archegos and really the cost of doing business with a wealthy client in the investment bank that didn't fall through to the wealth manager. Why does that matter, Kailey? Because there are existential questions, a very tense analyst call about the strategy over at Credit Suisse and the role of the investment bank for this giant.
And they actually said that they have ousted 9 employees as a result and recouped $70 million in pay. Split between 9 people, that's not bad.
Right. They've clawed back a lot of money from these executives, certainly. But this report also said there is more to do. But on top of that, again, what role does the investment bank play? We're talking about a bank that is one of the top 10 advisors on mergers and acquisitions in the world, facing a 34% drop-off in advisory fees here. So that is something the other European banks will certainly be watching, Matt, but also a drop-off in capital markets fees as well. Huge debt underwriter, huge IPO underwriter. Few people recognize they're one of the top 5 in the world.
Sonali, we also have Robinhood's IPO set to start trading today. It priced at the low end of its range. How big of a disappointment was this for Robinhood?
So listen, at the low end of the range, this is really setting expectations here. When you've seen other IPOs go to market, getting in there really high with a very high retail allocation, let's not be greedy here, right? I mean, this is still a company that is almost 3 times as much as it was worth less than a year ago. So that means the people that brought in the funding round in September of 2020 are facing 2.7 times the valuation they faced last year alone. The real question I have is, how does this trade into the end of the day? If they face stability, a lot of volatility, or face the Coinbase drop-off, as you see the people who bought in at $340 are $100 less than they were at that price. So those retail investors are really who are trying to be protected here.
Yeah, I, for one, cannot wait to see the price action on this debut today. Bloomberg, Sonali Basak, thank you so much. And speaking of price action, let's take a look at some stocks moving in pre-market trading here in the U.S. All 3 of them reported results after the bell yesterday. First up, Facebook beat in the second quarter. The issue is new rules from Apple, which basically allow users of apps to decide whether or not they want their activity tracked all across the internet. That is going to make it a lot harder for Facebook to target ads, and they say that's going to create a headwind through the remainder of the year. That stock down 3.5%. One stock moving to the upside, though, is Ford, a surprise profit of 13 cents a share. Analysts were expecting a 5-cent per share loss, so a big beat there. Even though the company is dealing with the chip shortage, the fact that car prices are so high is giving a nice lift to those shares in early hours. And PayPal, of course, also moving to the downside, missed in the second quarter, really hurting from the loss of revenue from eBay. The company saying that unwind is really happening more quickly than expected, and as a result, that stock is down 5% in early trading, Danny.
Kailey, I really have to wonder how long these tech losses last for. I mean, growth does feel like it's kind of the only game in town right now. And coming up, we're definitely going to get into some of that growth value picture. We have Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. So we have earnings, we have the rotation, we have Fed, a lot of forces to come through this morning. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York. Danny Berger is in London. Francine Lacqua is off this week. Well, a surge in coronavirus cases and the return of mask recommendations in the U.S. are impacting company plans to get more workers back to the office. Google and Lyft have delayed their return date, and Twitter has shut its recently reopened office. You also have companies like Disney requiring masks in theme park once again, Apple once again requiring masks in most stores. All this comes down to a vaccination story, so let's get more on this with Susie Ring, our healthcare reporter. Susie, the main problem here in the U.S. is that enough people aren't vaccinated and therefore are vulnerable to the Delta variant. And we got some vaccine news from AstraZeneca today. Can you tell us about that?
Yes, sure. I mean, we've seen obviously vaccinations, I think, increasing a little bit in the US recently, but it's interesting to note with the Astra revenues today, we've got a big uptick in sales for them on the COVID vaccine. They've also actually said for the first time today that they are definitely applying for a full biologics license for their vaccine in the US. We had been unsure about whether they were going to still try and pursue an emergency authorization, but their CEO confirmed today that in the next 2 to 3 months, they plan to file for a full license, and that would obviously add to the number of vaccines available in the U.S.
And they're going to stick to, they don't want to make a profit on these vaccines at Astra in their work with Oxford. Pfizer, meanwhile, is going to forecast revenue now of $33.5 billion for these sales. It's going to be one of the best-selling medicines of all time.
Absolutely. I mean, Astra has reiterated that from the start, one of the important things for them was to do this at cost so that they could make it really available to low and middle-income countries. Obviously, we are now seeing huge revenue projections from Pfizer and others, something around the range of $33 billion. I think Pfizer said yesterday for the year, compared with $1.2 billion that Astra's had in sales for the first half of this year, and that's at no profit. So, they're playing a different game. Obviously, post-pandemic, Astra will be in a position to make a profit, but they have reiterated today that they still expect to price pretty reasonably on that and for it to be a tiered structure so that lower and middle-income countries are paying far less than wealthier countries.
Right, and for now, AstraZeneca shares down about 0.2%. Susie, thanks so much for bringing us the latest. That's Bloomberg's Susie Ring. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York. Danny Berger is in London. Francine Lacqua off this week. Now let's get you the first word news. And China may be preparing for a period of prolonged tension with Washington. Beijing's new ambassador to the U.S. is a veteran diplomat known for pushing back against Western criticism. Qin Gang most recently served as vice foreign minister. People in London appear far more interested in getting back to shops and restaurants in the West End than in returning to the office. Minicab and courier company Addison Lee says passenger bookings in London's financial hubs have recovered less than expected. An executive described Freedom Day this month as, quote, a damp squib. And pro basketball star Kyrie Irving has some harsh words for Nike, which makes his signature sneaker. The Brooklyn Nets player said on Instagram that the latest version of the shoe is, quote, trash, and that Nike plans to release the shoe without his okay. No comment yet from the company. Interesting one with Nike there, Matt. I just would want to know exactly what the shoes look like and feel like, but apparently Kyrie Irving, not really happy with them.
Yeah, I wonder what Nike did to make him unhappy about that. By the way, I figured out what a damp squib is. A squib is an old word for a firework, and when it got wet, then it didn't work anymore.
Learn something new every day.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Matt Miller and Kailey Leinz in New York. Francine Lacqua is off this week. Matt, there has been this reoccurring theme of perhaps moving backwards or things not progressing as fast as anticipated when it comes to all things viruses. I think it's best put by a London cabbie. It's a squib.
A damn squib. Which apparently, so I had to look it up this morning. I've lived in London for years. I've heard this phrase over and over again, and I get what it means, but I just didn't know what a damp squib was. A squib is, like a child's firework, one of the little tiny, not even an M80, so a very mini firework. And when it gets wet, obviously it's not as much fun. For sure, Freedom Day probably didn't feel, like the 4th of July in London. And we've had some backsliding here as well, especially in states where people were vaccine resistant. But we're starting to see a tick up in vaccinations in those states like Arkansas and Missouri. And hopefully a spike in hospitalizations in Florida is going to lead more people to get the shot there as well.
Right, you have the carrot and the stick. I mean, the most recent carrot being New York City saying that they'll give you $100 if you get your first vaccine dose. Kailey, I'm sure you're bummed you missed that. I think you got your vaccine maybe too soon to cash out.
When I got it in April, I got nothing. And now you can get free college tuition. You can win the lottery. The incentives are really quite crazy. Clearly, I should have waited a little bit longer. As for what's taking shape in the markets this morning, of course, we saw that huge risk-on session in Asia, in part because of reassurance out of China, in part because of reassurance from the Fed. You also have that infrastructure deal finally taking shape on Capitol Hill, but we aren't seeing as large of gains in the European or U.S. session. Right now, the stock 600 in Europe is higher, but only by about 0.3%. And here in the U.S., futures are pointing to a firmer open, but we're up just shy of 5 points on S&P 500 E-minis. In the bond market, we are seeing yields tick higher, up 3 basis points or so on the 10-year Treasury yield, just around 1.26%. While it is a weaker dollar story across all of G10 today, the Bloomberg Dollar Spot Index down about 0.25%. Of course, we also had earnings rolling out overnight. Qualcomm giving a very upbeat outlook. Of course, it is the largest maker of chips for smartphones, and demand for new phones and 5G growth really lifting that company. Those shares up about 3%. Shares of Ford up 3.5%. It's reported a surprise profit. Analysts were expecting a loss. Those higher prices for cars really aiding the company. To the downside, though, PayPal missing on second quarter revenue, really hurt by the loss of eBay. That stock down about 5%. And Facebook down the better part of 4%. It's going to get hurt because it's not going to be able to target ads as easily. Blame Apple for that, maybe, but that is dragging shares of Facebook lower today, Matt.
All right, so a lot of movement in corporate in Europe as well. Volkswagen raising its outlook even as it cuts delivery expectations for this year. Still growing, but less than it previously had anticipated. Luxury brands from the car maker helped limit the fallout from the global chip shortage. They sold more Porsches, Lamborghinis, and Bugattis. I spoke with the CEO, Herbert Diess, earlier this morning.
I think we have overcome chip shortages so far quite well, so we could manage, we could rearrange. We have lost some sales in significant size in China, where we have been prioritizing. We got through this quite positively in the first half. We're going to see some hits now in the third quarter because production now is really constrained. We are managing through, but we are confident that we can recover then in quarter four, and this is why we are raising our outlook for this year.
Chips aren't the only problem, of course. We've heard from a lot of businesses that due to the resurgence in COVID, due to the Delta variant, return to office plans are being reversed. How is Volkswagen and its massive business across all of your units experiencing this new wave?
Yeah, as you say, we have more constraints to manage, but we have a very good team in place. They are managing supplies worldwide. We could manage supplies through COVID, through the first hit of the wave quite well, so we didn't lose too many cars. We always have some alternatives. We always can speed up supply. We have the long lead times in our supply chains. And now we will see some hits from semiconductors, but we strongly believe that in Q4, if we don't have really a reset on the COVID side, we should be able to recover to finish a very good 21 and then have a positive outlook. Most of our constraints people are working on, and there is capacity added. So I don't see any long-time constraints.
Herbert Diess there, the CEO of Volkswagen. They have at least 12 brands that they operate globally. I wanted to get to, and I'm going to get to the inflation story at Volkswagen, but I'm looking at a red headline crossing the Bloomberg terminal right now. Just breaking, Didi is considering going private, according to Dow Jones. And this is pretty amazing considering that the Chinese company has only been public for a month. I think the shares are spiking now, rising about at least 11% as these headlines cross the Bloomberg terminal. So, yeah, look at that, up 10% right now. Didi Global considering going private, according to Dow Jones. Very interesting, and fortunately we have Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs, standing by. This China story, Peter, has been fascinating to me, from fintech to Didi to tech, ed tech, and now we see that these big companies are going to have to make big changes. Was it dangerous? Was it a mistake for people to invest in China in the first place?
Well, a good question. Of course, we need to put it in context. China has seen tremendous growth for the last couple of decades, and significant growth in its market as well. And the opportunities and the increased exposure to technology sectors generated great returns for investors. But I think that as we get a shift towards an emphasis on domestic social policy, on levelling up, something that we're hearing in Western governments as well, you are obviously seeing this increased regulation, and that's really spooked investors. I think it's worth saying that this is being reflected really in a higher risk premium on Chinese domestic stocks, rather than being reflected in markets as a sort of growth shock coming from China. You know, we have baskets of companies, for example, with high exposure to China, based in Europe, and they've held up really very well despite this very big derating in the Chinese stock market. So I think this is being priced as a domestic risk premium issue, not a global growth shock.
It may be a domestic issue, but we are seeing the same buy-the-dip phenomenon in Chinese assets as we see with U.S. equities, really equities across the board. Buy-the-dip seems always to work. When is that not going to be the case?
Well, I think the buying-the-dip mentality in general does make sense, because we do have policy settings which are really going a long way to reducing the left-hand tail risk for investors. You know, the combination of extremely accommodative monetary policy and forward guidance, together with fiscal support, suggests that the deflationary risks that really dominated for much of the post-financial crisis era are moderating. So whenever we get significant setbacks in the equity market, there's a sense that there are valuation opportunities to be found, and I think that makes a lot of sense. That being said, I think the growth upside is probably capped to some extent as well, as we go into a slowing of global growth momentum.
Yeah, Peter, sorry for interrupting you. I was just curious. Okay, buy the dip mentality makes sense. Do you buy the dip in some of these tech giants that have sunk after their earnings? Can you afford right now to not be owning big growth tech names?
Look, I think the big growth tech names are still very compelling. They've got enormous moats. They're very cash generative, profitable companies. And valuations had come back a reasonable way, even in the US, during the rotation that reflected the big reflation trade in the earlier months of this year. So given the very strong growth rates that they have, the relative defensive nature of their businesses, I think that investors are still compelled to have a reasonable exposure to large technology, and that's still where we have an overweight, for example, in the US. That isn't to say that there aren't great opportunities in some value parts of the market, and of course value's been heavily hit, particularly in the last couple of months or so as bond yields have come down, but we think that there are interesting opportunities there And we do believe that bond yields will start to pick up again over the remainder of this year.
You know, even Jay Powell seemed to be stumped by the drop in bond yields and especially in real yields. He came up with 3 possibilities. He said it could be the spread of the Delta variant, prompting concerns of a growth slowdown. He said investors' inflation expectations have moderated, or it could be technical factors, which means, again, he doesn't really know why. I know you're an equity strategist, Peter, but I'm sure you spent a lot of time thinking about why real yields dropped to negative 117 basis points here. What's your takeaway?
Well, I think, again, when we talk to our own bond strategists, they find that a lot of the ex-post rationalizations for the falls in bond yields we've seen don't really fully make sense. So there are some technical aspects to it. I think the longer declines in real yields might also reflect to some degree the growth that we're seeing in government debt levels, implying that there is a limit to how much inflation and growth can pick up without having the effect of slowing growth expectations again. But when we look at all of the factors that Jay Powell and others have put forward, we think the rally has been too significant relative to fundamentals. We still have the view that 10-year Treasury yields, for example, will rise towards around 1.9% by the end of this year. And that should recatalyze some of the value trade that we were seeing playing out late last year and early this year as well.
Obviously, inflation expectations have come down, Peter, but companies are still feeling that inflation in a very real way. We heard that from the likes of Anheuser-Busch just today. How do you think about an equity strategy considering the pricing power that companies have?
Yeah, I think this is a critical point. I mean, we are clearly seeing areas where price increases are quite meaningful, even if that is not translating into broader rises in inflation or inflation expectations over the medium term. So margin sustainability is an important criteria, I think, as is indeed balance sheet strength. And both of these things, when we look at sort of baskets of companies with particular sensitivities, are areas that investors are really paying for. So companies that are able to hold on to their margins or pass through higher input costs, and those that have strong balance sheets are all characteristics that I think will continue to be very favored by investors. But of course, you know, where you are seeing these rising prices, there are always relative winners and losers. We think that the commodity-related part of the market offers very attractive valuations. You're starting to see companies buy back shares, giving money back to shareholders, very high free cash flow yields and dividend yields. And we still have a structurally bullish view on commodity prices as well in general. Part of this reflects the squeeze in supply relative to demand. Yep. Some of it, in the case of copper, for example, is really a secular trend reflecting increased focus on decarbonisation.
All right, we have to leave it there, but thank you so much for your time today. Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Valuable insight. Thank you so much. I do just want to quickly recap that news we got out of Didi Global, of course, the Chinese ride-hailing company, considering going private. This is according to a report from Dow Jones. Remember, this company just went public in the U.S. a month ago. It IPO'd at $14 a share, fell as low as $8 a share. And this morning in pre-market trading on the back of this news, the stock is up more than 30%, now nearing $12 a share. Again, Danny, Didi reportedly considering going private.
Fascinating story. We'll stay on top of it for you. But coming up next, we have Rajiv Suri, CEO of the UK's biggest satellite company, Inmarsat. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, T-Mobile CEO Mike Sievert. This is Bloomberg.
I'm going to recap the breaking news we have on Didi Global. The Chinese company is considering going private to placate Chinese regulators and compensate investors for losses. This, according to the Wall Street Journal. Bloomberg's Juliette Sally is standing by with more on this developing story. Juliette?
Hey, Matt. Yeah, this does seem very interesting, as you say, coming through from Wall Street Journal reporting that it could be to placate China and also compensate investors. And, of course, comes after we've seen this big crackdown from the Chinese government tightening their grip on tech companies in the country. Remember that Didi Global, which is a massive ride-sharing company in China, actually only went public just last month, and we'd had that huge IPO coming through. But then there's, of course, been concerns from the Cyberspace Administration of China conducting a review of the company, and that led to some potential threats about fines against Didi, suspension of part of its operations. So essentially this is an incredibly developing story, but also comes on the back of what we've seen about a crackdown on the online tutoring sector in China this week as well, which of course is what we've been watching, Kailey, all week.
Yeah, but Juliet, we also got news overnight that China was going to continue to let local Chinese companies go public in the U.S. so long as they follow certain guidelines and restrictions. So is it just that Didi didn't do things right?
Well, I guess that remains to be seen. I don't believe we've one saying that, but it certainly at the moment does seem to be that they're trying to get across the concerns that the regulators had, because they had these regulations, or this crackdown, I should say, from the cybersecurity watchdog. And it does seem, this developing news at least, that it could be just to compensate investors for these concerns and try and placate regulators as well. But there had been this huge on-site cybersecurity sweep against Didi, and that posed a little bit of an awkward conundrum for a lot of the Chinese regulators and, of course, for Didi itself.
Juliet, thank you so much for staying on top of this for us. That's Bloomberg's Juliet Sally in Singapore. Now, moving to Inmarsat, which is the UK's biggest satellite company. Its biggest clients include the UK and US governments, as well as companies involved in maritime, freight, aviation, oil, and gas. The company plans to launch a constellation of low Earth orbit spacecraft and set up 5G wireless networks, joining a new space race against the likes of Elon Musk. Rajiv Suri, Inmarsat CEO, joins us now. Rajiv, thanks so much for joining us. And obviously, there's a lot of hype around the space race and all of that right now. But can you put in really simple terms what this strategy means? Does it mean that on my iPhone now, I'm going to be able to ping Inmarsat satellites to get 5G?
What it means is that, this is it's called Inmarsat Orchestra. So we're redefining high-performance connectivity for global mobility customers, right? So we are not focused on consumer broadband. This is all about maritime, aviation, enterprise, and government. And so this will allow us to get the highest speeds, both worldwide as well as in hotspots. And congestion in hotspots is a big deal, especially in maritime. So fastest average speed, unique resilience for mission-critical applications, and then the lowest average latency of any network planned or existing. And this uses a multi-dimensional architecture. So it's going to have our dynamic mesh network that incorporates our GEO satellites, and we've got 7 more GEO satellites launching. It'll put together then a LEO network on top of that with about 150, 175 satellites. And then there'll be 5G ultra capacity for hotspots, such as in straits, canals, etc.
So why wait until now to do this? Low Earth orbit constellations have been a hot topic in the satellite business for a while, and it could take you until 2026 to get this online.
With our focus on global mobility, so this is about B2B businesses like maritime, aviation, government, enterprises. GEO is a very, very good solution because you get this massive ubiquitous global coverage. What we are trying to do, our need is not to go and launch thousands of greenfield satellites in LEO. Our need is to augment that capacity and to do that in places where it's really needed. So high demand places like canals and oceanic regions, and then add ultra high capacity with terrestrial 5G, really only to target these congestion hotspots. So, GX, which is our global express network for GEO, is fantastic and good enough for this. In the next few years, we see the need for hotspot congestion relief, but we also see the need for higher latencies and speeds in certain areas, and hence the LEO component comes in.
So how does this position you to compete with a company like SpaceX?
SpaceX focuses on consumer broadband. Our focus is on global mobility, right? So this is this government and enterprise and maritime aviation market. This is fantastic positioning for exactly this market because we have an L-band network that is great for industrial IoT and mission critical and resilient, all-weather resilient applications. On top of that, we have this GX Global Express Geo network, which is great for ubiquitous global coverage for exactly our sectors. So I think for our sector, this puts us in the best place possible of any company.
Rajiv, if I can take you back to 2019, Inmarsat gets bought out, gets a take private for over $3 billion. Warburg Pincus Apax put you at the helm. What has it meant for Inmarsat to move from the public equity space into private ownership? How has that shifted the company's approach?
You know, my priorities are technology leadership, have a customer-centric company, and then take advantage of our fantastic distribution. Because remember, a lot of our business is wholesale, indirect, and some of it is direct. And that distribution is not easy to put together for this global mobility customer base that we have. So it's allowed us to focus on, long-term investments, such as we're doing now with Inmarsat Orchestra. We'll also have something coming in our L-band reinvigoration, which is important for industrial IoT and asset tracking around the world. We've had a very good Q1 and a fantastic second quarter with very strong growth across the entire estate, all of our business units. And we expect to grow faster than the market, for 2021 as well. Maritime, aviation is seeing a rebound, both in in-flight connectivity as well as the business jet business. We're seeing a rebound in maritime. We're seeing growth in government, very strong growth in the U.S. government as well as, global government business. And then enterprise, which is our smallest business, is sort of being set up for growth to focus on new verticals like agriculture, rail, utilities. So I think this consortium ownership has really allowed us to focus on the long term and invest in technology.
Rajiv, thanks very much. Rajiv Suri there talking to us as the CEO of Inmarsat. I think it's, for our listeners and for our viewers, markets are thirsty for more information on space investment and satellite constellation. So it's great to have you on. I will also welcome right now our listeners on London DAB Digital Radio. We are, of course, simulcast this hour. This morning, I spoke with the CEO of Airbus as well. That company has raised its guidance for profit and aircraft deliveries. The planemaker says it will build a new freighter in a sign of rising optimism that demand is rebounding from the pandemic. I spoke with Guillaume Faury earlier.
We see inflation in many areas with raw material, very strong inflation on raw material. There is scarcity for a large number of them. We see also a lot of inflation on logistic costs, sometimes skyrocketing costs. And we saw also scarcity on some skills. After the period where we had to adapt the workforce to the pandemic situation, we are now starting to hire again. And it's not always easy for us and for the supply chain. So it's a new period ahead of us. We start to ramp up again on the 320. That's good. There is demand. Airlines are willing to take delivery of the planes again. But it's a very different environment. What we call the new normal, the post-19 COVID-19 situation is going to be different from the pre-crisis situation.
Guillaume Faury there, the CEO of Airbus, talking earlier today with me and saying they just are having difficulty finding the right people with the skill set they need to ramp up their plane production. Let's take a look at what else we are watching today. I'm keeping my eye on Robinhood. It's going to begin trading on the NASDAQ. As you know, that takes usually quite a few hours to get started, and I will be back in this chair anchoring at 1 p.m. I suspect that Robinhood, Kailey, and Danny isn't really going to start trading until just about then. So my show this afternoon could be focused pretty hard on Robinhood and the IPO. Danny, what are you watching?
Yeah, well, definitely I'll be watching you do that, Matt. But also, I'm still watching the NASDAQ as well. But Amazon earnings specifically, they come after the bell. Huge expectations for big tech. We've seen a variety of performance among them. But I also want to know, what does this mean for Jeff Bezos' wealth? Obviously, a big part of it is tied to Amazon stock. So how many more rocket ships into space will a blowout quarter at Amazon afford him, Kailey?
Good question, Danny. Well, I'm watching one other stock, and that is Didi Global, a company that has only been public here in the U.S. for a month, but reportedly is now considering going private to appease some concerns out of China. That is according to a report from Dow Jones. And on the back of it, the stock is absolutely surging, up about 30% in pre-market trading at the moment, as apparently, reportedly, the company is considering going private. Another thing to watch at 8:30 a.m. Eastern Time is a data dump here in the U.S., including second quarter GDP, the annualized read economy economists looking for 8.5%. So they'll be taking you through that on Bloomberg Surveillance. David Rosenberg, Research
cool.
founder and chief economist, will be joining them. And then later on, Bill Dudley, former Federal Reserve Bank of New York president and Bloomberg opinion columnist. This is Bloomberg.